Hey everyone, welcome back to my channel. It's Ben Morales, and I have a question for you today. Are you in your 60s and still trying to pay off your mortgage? I know that's probably a daunting thought for you to know and come to the realization that you're very close to retirement, right? The actual retirement age, and you are still trying to eliminate the biggest financial burden that you and I usually face. So you're not alone. I found doing research that actually 40% of 64-year-old homeowners still have a mortgage. So it's something that a lot of people are currently dealing with right now. So how do you pay off a mortgage when you're nearing your retirement? You have just a few years to work with. How can we more quickly and efficiently pay that mortgage off? Well, if you stay in the traditional finance realm and doing things the traditional way, you are going to be delaying your mortgage payoff. And when I show you this strategy here that would actually help you speed up that process and pay it off very, very quickly, you're going to see why. So I want to share with you a client here, a scenario. I want to give a backdrop and a story of where the client is at right now. And then we're going to take you through the process of the changes that he has to make. And it's just really one major change that needs to be made for him to more quickly and efficiently pay off this mortgage. And we're going to see if we can do it before the 5 years, before turning 65. So here's the backstory on the client. He has an income of $6,670. The expenses are $5,189. The nice thing is we're not dealing with a lot of debt. The only debt that the client has is a mortgage right now that's $165,000, and that mortgage is at a 4% interest rate. So it doesn't look bad on paper, right? But what do we teach on this channel? How you borrow is more important than the amount you're being charged for borrowing and how you're paying that back. Now, the cash flow here is $1,481 every single month. So let's look at a couple of good things that this client has going for him right now. First of all, the home value of the home is $340,000. So we can tell that based upon the balance that's owed in comparison to the value, there's plenty of equity in there to work with. So we have to reposition that equity to start working for him instead of being stuck in the brick and mortar like it is right now. So what we are going to see is that if you divide 165,000 by 340,000, we are going to get a number that's going to tell us our LTV. So the LTV for this current loan right now, he's only at 49% loan to value. So there's huge opportunity right there for us to start repositioning. So we're going to reposition that, but before we get into the details of repositioning, we're going to tackle where the income is going first. All right. So we are going to put a plan together, and what that plan is going to do is going to increase the cash flow and is going to decrease the expenses. In order to do that, we need a tool. We need a debt tool. Well, we already discussed that 49% is his LTV. He has more than enough room to do a home equity line of credit. That is going to be our debt weapon. Our home equity line of credit is the secret sauce, folks. This is what's going to help him get the job done. We're going to see how long it's going to take him to do that. Now, as I've been doing research, and you have to do your own research to this, if you need help with this, please put questions, comments in the section below, and I'll be sure to get back with you to give you some guidance with that. But what I found doing my research is that there are many credit unions in particularly that are offering all kinds of promotions, right? So I found, and none of these are sponsoring me, I just want to give you and inform you of the credit unions that are right now making different deals available. So the first one here is a credit union name. These are all credit unions, right? So it's Veridian Credit Union. When I was checking them out, they're offering right now 3.99% for 6 months. Okay, 3.99%, 6 months. Here's another one for you. Another one is Golden One Credit Union. Okay, they're offering 4.99% for 6 months. Okay, and I'm going to write one more down again. These they don't sponsor me in any way, shape, or form. I just want to add value and be a valuable resource to you. So when you're doing your research, you know the angle of how to approach this. The other one is consumers. And here in Illinois, where I'm at, this is one of the most popular ones. Consumers Credit Union. Right now, they're offering, look at this, 4.9%, 4.49% for 12 months, which is phenomenal. 4.9% for 12 months. So that's great. Why is it great, you ask? Well, in particularly the case of this client, we know the positive is as such. He has a 49% LTV. When you're out there and you're trying to get a home equity line of credit, one of the things that you want to focus on, one of the things that they will ask you, and even in this case, one of the things that will be a requirement for you to get this special promotion for that period that they're offering is your LTV, loan to value. So we know if he has $340,000 as a value of the home, we know that 80% of that is 272. Okay, do the math. 340,000 times 80%, you're going to get 272,000. That now becomes our line, our limit, line limit. 272,000 is what we're going to be working with. He's going to insure himself. It's actually 80%. Forgot the zero. He's going to ensure himself that he's going to get the best rate because he is staying within the 80% criteria that the bank is requiring. When you do that, you present a lower risk to the bank. You're going to get a better interest rate. In his case, or this example, he would qualify for one of these rates depending on obviously where he's going to do the loan. So I gave you an example here of 3 different consumer or credit unions that are offering some kind of promotion. Now, if you can look at these, right, 3.99, 4.99, 5.49, not too far from the 4% that he has right now. The big difference is how those loans payments are calculated. This is an amortized loan, right? This is an amortized loan, meaning that if you sent your entire income, $6,670, as a payment to that loan, the very next month, your payment will be the exact same thing, right? That's how amortized works. Now, the difference with the home equity line of credit and using it as a debt tool is we're actually going to not just use that as a debt tool to pay the line of credit, but we're also going to use it as a place where our income is going to on a weekly or bi-weekly basis, depending on how it is you get paid. Now, let's see how that looks. Right now, we're taught, right? You get paid, your money goes into a checking account. From the checking account, you disperse it to pay your bills. Among your bills is going to be your mortgage. But when you use a home equity line of credit, what you're doing is these following steps. You're going to take this $165,000 that is currently in the mortgage. You are going to be moving it into the line of credit, right? So now you're going to have a line of credit of $272,000, and you're going to have a balance in that line of credit of $165,000. What else is happening here? Let me move this out the way so you can see this more clearly. So what else is happening? Well, if we don't have to make a payment anymore to the mortgage of $225,000, then that is being eliminated because now we don't have to make a mortgage payment, and I'll show you what that means. What we're doing is we're going to minus it from the actual expenses. So if it's not a payment anymore, we don't calculate it in the expense cost, which means the new expenses becomes $3,164. That is the new expense. What's also happening on the other side is we are getting an increase of the same dollar amount, $2,025. And so now the cash flow goes up. The cash flow goes up to $3,506 because what you are doing is you're no longer leaving your cash in a checking account to then disperse and make payments. You're actually leveraging that cash that you're getting every 2 weeks or every week when you get paid, and you're going to place it right back into the line of credit to speed up the process of you paying off this loan. So now we're going to solve how much loan amount gets paid off in the 6 months, taking one of these particular deals. We're going to go with the middle. We're actually going to use Golden One Credit, 4.99. Again, depending on where you're at, I believe they service California. Viridian, I believe they service Iowa, Nebraska, Minnesota, and Consumers Credit is here locally in Illinois. So depending on where you're at, you have to do your homework, continue to find out where they service, and apply with that particular credit union. But now let's look at the nuts and bolts of how this looks like. So here's the 165,000, which is now the balance that is still owed, but instead of being in a mortgage, it's going to be in the home equity line of credit. So the beginning of the month, it's 165,000 is the balance. Now we are repositioning the cash flow from a checking account, and we are positioning it as a payment into the line of credit. And that's why you see it being minus. The entire amount every 2 weeks when you get paid, the entire amount is going into the line of credit. But what also has to come out of that line of credit, so it has to be added back in, are the expenses, which remember, because now it's not a separate payment like it was here, it's actually cash flow, and they dropped the expenses that were up here at a total of 5,189. That means now that the expenses are 3,164, and then this is the interest rate calculated at a 4.99. Now, the most that you will pay in interest is $676.80 if the balance were to stay at $165,000. But we know that during the month, because the income is going placed into the line of credit, that balance is actually going to be a lot lower. The end of day balance are going to be lower, and that's how you speed up the payment of the loan. If we move on to month number 2, we can see where the month starts. We can see that at a 4.99%, this is the most that interest will be paid. So the income is going in, the expenses are coming right back out, and we're also going to add that interest back in. This is where the beginning of month number 3 is at, $159,329.90. Now, after we rinse and repeat and do the exact same cycle, our total is $156,477.30, which is the beginning of month number 4. And we are really cooking right now because you're getting excited. You're seeing results a lot more quicker and a lot more efficient than what you would have done in a regular mortgage. So moving right along, $156,477, income goes in, expenses are coming out, interest is being added. It's going to drop it down to $153,081. And then we're going to do the same thing number 5, the same thing number 6, right? So in month number 6, when it's all said and done, when that 4.99% interest rate is going to finish, we will be at a balance of $147,313.70. Let's do the math on that. This is where we started, right? We already determined that's where we started. $165. The $165,000 is right here. Now we're going to deduct the difference. $147,313.70, and let's see where the balance is now, which would be $17,686.30 or 30 cents rather. That's how much we took off of that loan in just 6 months using a home equity line of credit and repositioning our cash, putting our cash into it as a payment. It's down $17,686.30. That is just absolutely phenomenal. So you can see, I actually went back and I did the entire math with the rest of the breakdown of the payments. The only thing that I changed to a 7% interest rate was this Golden One credit. So after the 6 months, I made the assumption that rates will be about 7%, which according to the Federal Open Market Committee, they're going to be meeting more, at least another, I think, 6-7 more times this year, and they're anticipating lowering the rates once or twice. So the interest rate I chose is probably a little bit high, but it's better to be a little bit high than to be under. So at a 7%, from this point forward, this loan will be paid off in an additional 3 years and 6 months. So my question to you is, if it took 6 months to get here and another 3 years and 6 months to pay off, even though it has a higher rate, did we finish paying it off before the age of retirement? And the answer is unequivocally, yes, we were able to do so. So this is how you can do it. This is possible, folks. I don't know if you've been out there in the internet looking at YouTube, checking about this strategy. It's velocity banking. It's a simple strategy because it's math, right? It's all about where you're repositioning your income on the first base. So in the first place, I meant. So I hope this helps. If you have any questions, you want to help implementing this, put it down in the comments, please. I'll get back to you just as soon as I can. Continue to like, subscribe, and share this information so that more people in this position can find themselves a way to pay off their mortgage and enjoy retirement in a smooth way. So I thank you for tuning in. Take care and God bless.